Hello everybody, thank you for watching this video. Today we're going to discuss the topics of do low-cost investment give investor higher returns? The first question we're going to discuss is what are the costs that's involved in investing in funds. There are two kinds of fee, transaction fee and annual expense fee. Transaction fee is the one-time fee that investors incur when they invest into the fund. They are called sales charge, upfront fee, and in some cases it's the difference between the buying and the selling price of the fund, and we call them bid and offer spread. There's no debate about it. The lower the cost, the better. Low cost means better returns, right? An investor also should be careful of excessive switching fee if their account applies switching fee. One other form of transaction fee that investors should be careful of is redemption penalty in some investment structure. Be careful not to get into such structure. For annual expense fee is the management fee, trading costs, and also marketing expense of running a fund. This is commonly called total expense ratio. Some funds they call it an ongoing fee. Now as investor, when we invest into a fund, our expectation is that with the fund manager's education, skill, superior resources, and timing in monitoring the investment, they should consistently deliver better returns. In reality, however, research and historical data have shown that actively managed funds that charges high fee have consistently underperformed low-cost index fund. So then how should it invest? What are the different investment approaches? Essentially, we can approach investment in two ways: passive investment or active investment. Passive investment refers to the buy and hold approach, where we buy into a passively managed fund or known as index fund. For example, if you buy into an index fund that replicates the Straits Times index, effectively you're buying into the 30 biggest companies that listed on the Singapore Stock Exchange. Passive investors believe that a market is efficient, that is, they have the confidence that the price reflects the collective knowledge of all the investors, and it is hard to consistently find mispriced securities, meaning there's no free lunch. Passively managed funds usually have low annual expense of about 0.5% per annum or lower. In some cases, it can be as low as 0.1% per annum. Active investment, on the other hand, seek to outperform the index through stock picking, market timing, or sector rotation. They are called active funds. In our previous example, the fund managers can buy any stock that is listed on the Singapore Exchange and not limited to the STI component stocks. They believe that they can find mispricing securities, buy low and sell high. They also believe that they know which sectors will do better or the market will go up or down in the futures and profit from that. The annual expense of active funds are at about 2% or higher. Next, let us look at the performance of active versus passive funds. According to the data compiled by S&P Dow Jones Indices, the number of active managed US equity funds that beat the S&P 500 index over a period of 10 years is less than 15%. Overwhelmingly, majority of the funds fail to beat the index or the benchmark. Even in less efficient markets such as the emerging markets, the number of actively managed emerging market funds in the US that beat the S&P IFCI index over a period of 10 years is only around 18%. Survivorship of the active funds is a more even worrying fact for investors besides underperformance. Over 10 years, only 54.35% of the active fund that benchmarked against the S&P 500 index survived, with the rest closing or merging with another fund. So, choosing an active funds that outperform the index is one challenge. Choosing one that will still be in business over 10 years is another. So why do most active funds underperform? One clear reason is fee. Before cost, active investment is a zero-sum game. Active investors that earn above market returns at the expense of other active investors. For example, let's assume that there are only two fund managers in the markets, A and B. And let's assume that the markets give a return of 10%. So if fund managers A earn a return of 15%, that will mean fund managers B will only earn 5%. After cost, however, active investment is a negative sum game. So in the example, let's assume that the running cost of both the fund is 2%. That will mean that Fund A will earn a net return of 13% and that of Fund B is only 3%. The average of these two funds is 8%, which is 2% below the market returns because of cost. Besides the fact that majority of the fund managers facing an uphill task of overcoming their high costs in order to beat the index on the long term, it is also extremely difficult to know who have the skill to do so. Investors do not have reliable evidence to base on for them to select funds that will outperform in the long term. Adding to the difficulty is also that the performance of active fund managers are extremely inconsistent. In March 2012, there are 664 funds that are in the top 25% of the US equity funds. By March 2016, just in 5 years, only 0.3% of those funds, that is 2 out of the 664 funds, remains in the top quartile. For the above reason, at Providend, we always recommend our client to invest in low-cost, well-diversified funds for the long term, as we believe that this will give them the greatest probability of obtaining the highest investment return. I hope this video has been useful for you. If you would like to have a higher certainty of obtaining better investment returns, please feel free to contact us and speak to one of our very friendly and experienced client advisor.